That's the thing that you need to understand. It was literally under his nose the whole time, but he didn't see it as an opportunity to create a venture scale company because he was focused on this other thing. So think about what an amazing story this is. He gets to that decision really early that Glitch isn't going to make it. That frees up his time and attention to go explore. And then he sees what was already there, which he literally couldn't see before. Oh, I've got this thing that might be really cool. And it's Slack.
All right, welcome to another episode of Creator Lab. This is your host, Bilal, and I have a very special guest today. Annie Duke is here to join us today to talk all things quitting. Annie, welcome to the show.
Thank you for having me.
Yeah, well, I've been following your work for a while. I know you've got another best-selling book from the past, but you've got a new one coming out right now. People might have heard of Thinking in Bets, which was your last book, and really popular in the tech world and in the startup world, entrepreneurial community. Most of the people listening to this are also into that world. So we're not going to talk about that. I think you've done probably hundreds of podcasts on that, and it's been around for some time. But there's some new ideas and research and stories that you're going to share in this new book. So we're going to touch on a lot of those today. But before we do that, I just did want to talk a little bit about your background in poker. So that's kind of where a lot of people know you from originally. I've got here in my notes that you've won more than $4 million in tournaments in poker. And I'm just really curious about this world. I mean, I've only played poker like at college with friends and stuff like that. So I'm not like an expert by any means. But just tell me a little bit about that world. How did you get into poker in the first place?
Oh, well, I mean, it was somewhat accidental. So, now poker's on television. There's internet poker. But back when I started playing, none of that existed. So it wasn't like people didn't really know that. I mean, people thought about like poker as like home games or something, but it wasn't generally thought of as something you could do for a living. So the reason why I started playing it was I was at graduate school. I had been at Penn for 5 years studying cognitive science, and I got sick and ended up in the hospital. And so I had to take some time off from grad school, and I needed money. And just my brother, Howard Lederer, had already been playing. So he had gone off to New York to take a year off from college to go study chess. He wanted to become a grandmaster. And back in New York at the time, he had started playing 10 years before I ever did. It was like chess and backgammon and poker and gin, and they were all kind of intertwined. So he got introduced to poker through that world, and he actually became incredibly good at it. And so like all through when I was in college, because I went to college in New York, I would sometimes go and watch him play. And then when I was in graduate school, he would bring me out to Las Vegas for a vacation because I could not afford one myself. And it was during like the World Series of Poker, which was like the World Championships. And so I was like a little bit familiar. I'd watched him play. I kind of knew the rules of the game. And so when I had to take a leave from graduate school, he's the one who said, well, why don't you try playing poker to make some money in the meantime? I kind of, from watching him, I knew enough about the game that I started having some success right away. And that's how I started playing.
That's amazing. And so it sounds like it wasn't just poker. There was chess, backgammon, all sorts of stuff going on in your house. Is that something you grew up also? I don't know if your parents or anyone played any of those as well, but just sounds like kind of a fun house. Like, what was that house like growing up?
I don't know if I'd call it a fun house, but
okay, fair enough.
No, I don't think, did we ever play backgammon? I don't think we did. I don't think we had a backgammon board. Lots of Scrabble, chess, but tons and tons of cards. So my parents actually met over a game of cards. My father was playing bridge with some people. They needed a fourth. My mother was moving into her apartment right above him because they went to the same graduate school. And he just like ran out and asked if she played bridge. And so
she became the
fourth. I think they really did need a fourth. So they played bridge together, but we played like gin, and we played hearts, and a game called Oh Hell, which is sort of a simplified version of bridge. Didn't really play a lot of poker in the house. We had a one of those round things with the plastic chips in it that were really popular back then. So we played a tiny bit, but they were games like baseball, which involved real, wild cards, or a game called Pass the Trash, which people also might know as Anaconda, where you're actually passing cards back and forth, which you would like never do in a casino because it would just invite cheaters into the game. So it like nothing like what you would, nothing like Texas Hold'em or like any of the games that you would now know as poker. And it was very occasional. We mostly played bridge and Oh Hell, to tell you the truth, and hearts, games which I loved. There was some chess, and my brother would play chess with my dad. And then when he was 14, he started getting really serious about it. And there were lots of chess books in the house. But I was younger and didn't really get into that game. But he was traveling around to tournaments. I sometimes accompanied him just for fun and really playing on the chess circuit because he really had some dreams of becoming great. But he became great at a different game. So
awesome. Well, yeah, we're going to get into this idea of quitting, but the reason I'm asking these questions is because I think I've done a few interviews with even people who played chess growing up, and like they ended up becoming very impressive entrepreneurs, or, in their fields, they were doing really interesting things. And I think a lot of parents, I think chess is normally seen as quite a positive thing for kids, like if you're kind of a smart kid, you might be in a chess club. But I think even like video games, and I'm not saying they're exactly the same thing, I think a lot of parents will see their kids play video games and say, oh my God, I need to limit the amount of time they play, which might be a good thing in some ways. But the more I've kind of dug into it, I see even with myself, like the things that I'm good at naturally now, like for my work for a long time, my job was just to look at numbers and like scan very quickly and pick out the most important stuff. And there's a game I used to play for 12 hours a day when I was a kid called Championship Manager, which is like a soccer, football management game. And all you're doing is looking at numbers all day, and you're looking at Excel. Yeah.
There's a game like that in the US. And I know so many people who are options traders who played this game. It was called Stratomatic. Have you heard of it?
No, I haven't heard of that.
So I think it was similar. So
got it.
But in this game, you rolled dice, and you would have cards that would be like a baseball player's card. And it would tell you what the odds were of a hit, what the odds were of like a base hit, a double, a triple, a strikeout, like so on and so forth. And you were collecting cards and trading cards, and then you would roll the dice, and basically it would be like different combinations would get you a hit. So you had to be calculating all of those odds in order to understand like what was your lineup supposed to be, and so on and so forth. So it caused you to have to do that math on the fly.
Got it.
And I know so many people who like either got really into sports, like somebody like Mike Lombardi, who was a GM and talks a lot of sports, particularly football. And he's amazing. People should look him up. He's written some great books. And then I know all these options traders who played Stratomatic when they were young. So it's very simple. I'm sure it was the baseball version of what you're talking about, or similar.
Yeah. But I know in baseball, similarly, I mean, even more so than football and soccer, when I say football, I mean English football. Yeah,
I've been watching Welcome to Wrexham, which is amazing. Oh,
yeah.
It's so
I've started
good.
watching it. Yeah, and for people who haven't watched it, it's Ryan Reynolds, the actor, and his partner, I forgot his name. Rob McElhenney.
From Always Sunny in Philadelphia.
Exactly. And they went and bought a football soccer club in the UK, like in the lower division. And it's a really cool story.
Like, they had been demoted so many times. They were in the fifth one, which isn't even like their players were getting paid $30,000 a year.
Yeah, completely. And it's a really cool idea because, I mean, literally playing that game, I was saying Championship Manager, once you get good at it, that is what you do. You go and get one of the lower league teams that you like kind of grew up in the area, and you take them to become Champions League winners and stuff like that. So that's a long way of saying I'm really curious about how like these different abstract things that seem abstract apply in, you know, later life, in work, in personal world, in your personal life as well. So to kind of, just to wrap that up before we move on to the idea of quitting and how important it is, I'm curious, like, what makes a really good, a great poker player? Like, a good poker player is like someone who beat me at college, but at your level or like a competitive level, what are the characteristics of a great poker player?
Well, I think it's a couple things. I mean, obviously, exactly what you're talking about, which is the ability to calculate, you know, odds and really understand what those are pretty quickly, is important. Really being able to map uh, behaviors onto hands. So you're going to behave in a particular way, and I have to be able to build a model of your behavior in order to narrow down what your cards are, and then understand, given the range of hands that you have and who you are, what are the different things that I might do in order to optimize the amount of money that I'm going to make. So that's kind of like the nuts and bolts. But if I were to think about like temperament, um, you have to, you know, I think I did a radio lab a long time ago where someone said to me, like, aren't what players doing, like trying to get to a place where they're certain, you know, like they're really good at establishing certainty. And I said, actually, it's not that at all. It's that poker players are really good at embracing uncertainty. And the reason for that is that you have to recognize that, like, again, I said, you sort of narrow it down to a range, and then you have some set of moves that you can make against that range. And you're trying to figure out what the highest probability one is, with understanding that you might get it wrong. You could lose the hand even though you make the best play. You could win the hand even though you make a terrible play. All of those things can be true. And you have to just sort of embrace that you're just deciding under those conditions, because otherwise there's a whole bunch of really bad things that can happen to you. Like here's something that happens to amateurs, and you can tell me, Bilal, if this has ever happened to you.
Probably has.
You have a hand that you're playing, and you know you're playing for fun, obviously, but you have a hand that you're playing and you decide to fold it. And then other people are continuing to play the hand, and the rest of the cards come out, and you would have won. Is that not like the most painful thing ever?
Yeah, and I don't want to turn this into a therapy session, but it also feels a lot like life too, right? Like you're...
Well, it actually gets into quitting a little bit, funnily enough.
Yeah.
But since you asked me the poker question. So here's what will happen to amateur players is they'll start playing a lot of those hands. And you'll hear them say things like, any two cards can win. And, you know, the elite players are like, sure, but not enough of the time. Right? Because they understand, like, I'm going to fold lots and lots of hands that would have won. And in fact, a prerequisite to becoming a great player is folding lots of hands that would have won if you had stuck around. Yeah. But just because it turns out that with your 7 deuce offsuit, you would have made a full house, doesn't mean that you're supposed to play that again. And I actually have a story in Thinking in Bats, my 2 books ago, where I talk about this guy, Nick the Greek, that I used to play with when I was first starting to play poker. And I really, like, he decided that aces were a terrible hand and 7 deuce offsuit was a great hand. And here was his theory about it. Everybody expects you to have aces. But there's first of all, they don't, because it's very rare that you get aces. You don't get aces, get dealt aces that much. It's like 1 in 200 and something. So, but anyway, everybody expects you to have aces, but nobody expects you to have 7 deuce offsuit. But what was really happening was that he had lost a few times with aces, and those were memorable. So he wasn't able to sort of think in the long term about what the odds were. And it created this really weird behavior from him where he didn't want to play aces, but he wanted to play 7 deuce for like the surprise factor. And obviously he lost all his money. Actually, I'll tell you what actually happened. Yeah. So he was the manager of the hotel across the street. So I played at a place, I started playing in Montana at a place called the Crystal Lounge in downtown Montana, which was a very smoky basement bar. Whatever you think you're thinking of when you hear Crystal Lounge in downtown Billings, Montana, that's probably correct. Like, I'm not going to correct whatever your image is. And across the street, there was a hotel called the Northern. And he was the manager of the hotel called the Northern. I think he worked for like whoever owned the Northern internationally, he worked for them and he'd been brought in to be the general manager of the Northern. But on his afternoon lunch breaks or after work, he would go and play. So I would try to make sure, this is how bad his aces and seven deuce strategy is. I would always make sure that I was there like at his regular time, like I had him clocked. And
That's
I was
hilarious.
like, let me make sure I'm playing when Nick the Greek is there. So so he would really, like, for real, like sometimes he would just fold aces face up, like right away. This is literally the best hand you can get dealt. It has the best odds of winning. He would just fold it right away. And then if you ever had a hand and there were two deuces on the board, you'd be very cautious against him. You'd be like, oh no, like you could really have that.
And so what, would he show the cards basically so that everyone would see, okay, he folded that. The
because
best
he was very
cards that
proud
what
of
traditionally
his,
is. Got
super
it.
proud of his theory. Super proud of his theory. Well, anyway, one day Nick the Greek doesn't show up and I don't really think much of it. But anyway, he doesn't show up for a few days, at which point I'm like, what happened to Nick the Greek? Where is he? And it turned out that he had gotten deported back to Greece.
Oh, he was actually Greek. Okay.
He was Greek.
Because when you said Nick the Greek, I had this vision of like a Guy Ritchie movie,
Greek.
like in Lock, Stock or Snack or something.
No. He was actually Greek. He was actually Greek. So anyway, he got deported and I was like, oh, that's interesting. Why? And I don't know that this is 100% true, but the rumor was that he was kind of stealing from the till in order to play poker, like stealing from the hotel's till in order to play poker. I don't know if that's true or not, but that was the rumor. Let's just say that was
Fair
the rumor
enough,
way back then.
Word on the street.
So he had a bad temperament for poker. So you have to think about, like, it's one long game. You're going to win and you're lose. You're playing the odds. You're sort of grinding the edges, meaning like however much you're winning on a given bet. You have to be really open-minded. You have to embrace uncertainty. It's like a whole bunch of stuff like that. And then I think that you really have to figure out like how to get to the outside view, which just means like, stop thinking about the world in terms of what you want to be true or in terms of wanting to feel like at all times like you're a great player, which is going to cause you to reject the reasons that you might have lost the hand as having to do with skill, which is really bad for you long run, and really try to get to the heart of the matter and start exploring, like, what are all the different ways that I could have played this hand? Let me talk to some smart people to try to get their opinion. And so I would say, like, if you took a poker player and you did like the big five, like Ocean on them, definitely very, very open-minded. And I think also very disagreeable. And just for people who don't know Ocean, disagreeable in this case isn't a bad thing. It just means that you're willing to see or think things that are different than other people, which I think is incredibly important.
Yeah, for sure. And so I think a lot of people who are listening to this, like I said, are interested in business, investing, entrepreneurship. And so you actually have a role with First Round Capital, right? A seed stage fund. A lot of people would have heard of it, obviously, listening to this. I've got in my notes, you're a special partner there, and your focus is on decision science. So, well, could you tell me a little bit more about your role at First Round? What are you doing there?
So I've been with First Round for about 4 years. I started off just working with Josh Koppelman, who's the founder and a managing partner there, trying to help him answer some kind of complicated questions using data. So, well, although he didn't actually know we were going to use data, but we did. Seed stage investing is actually has a lot of the same, issues that poker does, in the sense that while poker's feedback loops feel like they're very short, there's so much luck involved that it's actually hard to sort of get the right feedback. You can, after, a year, you can figure out, I've put in enough hours to know that my results are probably pretty true because it's enough large numbers. But you're having to sort of close these feedback loops in a situation where it's hard to sort of discern luck from skill, which is hard to do. So he needed to answer some questions for himself and the firm in an environment where power law applies. So again, you're approaching a very similar problem, right? Which is, some things are going to hit, some aren't. What does it really mean, right? Like if you miss a unicorn, what does it mean? If you hit a unicorn, what does it mean? And these are hard questions to answer in that type of environment. And so we were really working on that together as a project, just the two of us. I think, we enjoyed working with each other and decided that we wanted to go broader. He then introduced me to the rest of the partnership. And then I started working with the whole partnership. And for 2 years, what we did was really work on their decision process for how are they really making decisions. We really worked on three things. How are they making decisions in terms of when the company comes in the door? And how are you thinking about the way the partnership is interacting with each other in order to get higher quality decisions? So this is really combining a bit of poker and a lot of my cognitive science background to work on that with them. Then we started working on kind of follow-on decisions, right? So really thinking about when you invest in a company at seed, you also buy an option. And that option is to be able to participate at later rounds or to buy up at later rounds. And so, I think that at a lot of venture funds, the way that those decisions are made is that the point partner, if they have conviction, you just do it. And I would say that that's a little bit the way that first round did it, but we started to make that to try to create more fidelity, more repeatability around those decisions to, I think, really good effect. And what came along with that was really modeling what sort of companies, what signals might tell you that companies are worth following on. And now they actually have a follow-on fund. So that work now becomes much more important. So then after about 2 years, that contract was up. And so I was actually writing this book, Quit. And I went to Josh and I said, well, we've done a lot of work, a lot of heavy lifting. Do you want to keep working together or not? And he said, you're writing a book called Quit. Are you trying to quit? Which I thought was really good. I was like, no, I'm trying to give you the option to quit. Like, I don't want you to feel like, if you feel like we've done our work together and we're good, then we should separate. And he said, no, let's both of us really wanted to keep working with each other. We just wanted to make sure we had the discussion about it. At which point I got a title, which is special partner focused on decision science. So, I kind of do all things decision science there, really thinking about, not cleaning up decision making, but then also now working directly with founders and helping them think about how to improve their decision making. And it's a super fun job. It's a great group of people.
That's awesome.
I love them. I really do. I think they're awesome.
Yeah, I mean, they're definitely one of the biggest names in venture capital and really well respected. And I think as it says in the name, first round capital, they're seed stage, so they're normally early, or they are early. And like the idea of, like quitting on a winner, or sorry, not a winner, something that isn't going to plan, and then having to not do a follow-on round or whatever. Yeah, that seems like something that is very relevant.
So go ahead. Say it again I don't interrupt you. No, say it again so I don't interrupt you.
Yeah, I was just saying, because a lot of, the numbers generally, from my understanding, are 9 in 10 startup investments, especially at the earliest rounds, end up being worth zero. So, or they're not going to be the outcome that you're looking for. And you're really looking for that, like 1 in 10 or maybe 1 in 20 even, startup that really like pays for the rest of the round almost, or the rest of the fund or something like that, from my understanding. So like the idea of when you're that early, the risk level is the highest, and later down the road, you might keep thinking, like you said in the poker example, I'm already down here. Like I'm just going to keep going in. I'm going to keep playing. When in reality, you should have probably taken a step away. But yeah, I'm curious if that marries with the way your experience has been in that world.
Yeah. So, I think in general, people don't think that quitting would apply in venture, for the reason that it is a long hold investment. So, quitting, which is just selling, right? They think doesn't really come up unless sometime later there's a chance to trade on the secondary market or the company IPOs. Obviously, then you would think about, do you want to sell or hold? But, mostly you're holding the investment for a really long time. But this is where we need to understand, like, quitting we think about quitting as like walking off the court, right? But it doesn't necessarily mean that. And as you just pointed out, Bilal, like, just right. Quitting is also you invest in the company at, say, seed, and then there's all these subsequent decisions that come up that don't have to do with selling what you have, But the question is, do you want to buy more? Right. And given that that option is coming up, if you refuse that option, that would be a form of quitting because you do own that option. And you're saying, nope, I don't want to exercise that option. So that is
And
absolutely a form of quitting.
and Annie, also in venture too, that kind of signals, right? Like to other people, if you're not following on, you're not putting in more money, that might signal to other investors like, oh, if they were the earliest people in this and they're not putting money in the next round, that often can be like a negative signal too. So it's something you have to really
first
consider.
Round, actually, just to be clear, first round invested seed, they always follow on at A.
Oh,
that's
wow.
an
Okay.
automatic follow on. So that's a commitment that they've made to their founders. And there is no signal about what happens at B because people wouldn't expect somebody who's investing at C to follow on at B.
Okay, fair enough.
So in that sense, the only signal that they would send to the market would only be on the positive side, not the negative side, which is if they decided to buy up, in other words, increase their ownership at A. But if they follow on at B or follow on at C, obviously that would be a positive signal, but not a negative signal toward a company that they chose not to do that with. Again, because it's very rare. And there isn't a lot of expectation that would happen. So I just want to be really clear about that. There's an automatic follow on at A. So there's no decision to quit. You can't quit at A. They've tied their hands to that mast, which is, for a variety of reasons, it's a really good decision. Not just that they're there to support their founders. So these have to do with questions about, do you buy up at A? Do you increase your ownership at A? Do you follow on at B? Do you follow on at C? These are the questions where there is this option. And you can exercise that option or not, right? If it's available to you. And if you don't exercise it, it would be a form of quitting. I mean, you're still supporting the founder. You're just refusing this one option. And so we've really thought very deeply about, what are the signals and signs that would tell you that, say, a follow-on at C would make sense in this particular case. Again, it's pretty rare. But one of the things that you want to do as a VC is to, as you start to get signal from the world about what's going well and what's not going well, you want to start to concentrate your capital into the ones that are on that trajectory, as you said, for say that 1 in 10. What's interesting though is that when you look at if you look, so even though that's like completely logically what you would want to do, when you actually look at the behavior of a lot of venture partners, they don't necessarily do that. And this is a very, very common problem, which is when you see that a company is faltering. So this isn't going to be a case where a company is clearly over, right? But these are going to be the ones that are kind of faltering on the edge. Your tendency is going to be to put capital into it for really because of things that have to do with like the sunk cost fallacy, right? So the sunk cost fallacy is when you started to sort of lose in something, we have a tendency to want to spend more in the future to try to save or not waste what we've already put into it. Now, these decisions are irrational because what should matter is it worth it to put the next dollar into something? So simple case would be, you buy a stock at 50 and it's trading at 40. Do you put $1 in? Do you continue to hold it? In other words, which is continuing to put your money into it. Even in a case where if you hadn't bought the stock, you would not consider it a buy at 40. So you come to the decision fresh, the stock is trading at 40. If you would say, no, then I don't want to buy it, then just because you bought it at 50 and it's now trading at 40, you should not hold it. But we do. And the evidence on this is very, very strong that we do. So that's the sunk cost fallacy. So those kinds of things can cause you to concentrate capital in an attempt to save what you've already put into something. So this is a very, very common error. And that's something that we think about a lot over at First Round, trying to avoid that particular error. And one thing I think is quite funny is that we will do postmortems sometimes on companies that have now sort of like had their result that didn't do well, where there was some decision to concentrate capital at, say, C, and then the company did poorly. And they're doing a postmortem on it. And I'm not kidding. I'll just come in and look at it and go, we don't need to do a postmortem because under the new system, you wouldn't have written this check.
Yeah.
And it's very common. So again, nobody's going to concentrate capital in the company that's, last rung. It's where the company, like, there's some chance you could turn it around, but the company is not doing very well. And that's the dangerous spot when you have very limited resources in terms of the companies that you can actually concentrate capital into. And you want to make sure that when you get to those later rounds that you're putting the money into, the lookers, for example.
Awesome. All right. So let's get into the ideas from the book. So the new book is called Quit: The Power of Knowing When to Walk Away. And so I know that is the central theme here, quitting, like we've just discussed for the last 20, 30 minutes. But the way you described it there to me sounds more like it's not just about quitting, it's about just decision making, sound decision making. And quitting is one part of a wider, kind of idea of like making good decisions based on logic and being aware of some of the things you just mentioned there, like the sunk cost fallacy. And there's a few more that we'll get into today. And a lot of this just comes down to like human emotions and psychology and the way we all believe, the way we kind of live our lives and the way that we kind of think. And then I think if you extrapolate that from the individual, it's also about thinking in groups. And I think just even in the public markets, you can see over the last year and a half or 2 years, especially, we went from the crazy bull market of euphoria. And I have a second podcast called Not Investment Advice, where we also talk about, funnily enough, investing, and also like we covered a lot of crypto and all the craziness that was happening in NFTs and crypto world. So if you just think of that world where people are just doing crazy things and it's really not regulated, and exactly the idea you said there, right? Like you buy something at a certain price and you have an idea of it, and the price goes down and you are told, if you believe in something, to dollar cost average, and you just keep buying over a period of time. So that becomes kind of one of these things where if you are really dollar cost averaging, you're not actually thinking too much. You're just buying every month or every 6 months or whatever. Yeah. But in reality, what happens is you're like, oh, you're trying to time the market. You're looking at the price and you're looking at the chart. And so that is where I think most people, including myself, should probably not be doing that, because I'm not really skilled and trained to be doing that. So we're going to go into some of those ideas.
Say
please.
That the most expert investor in the world is not going to be able to time the market. So please don't try yourself.
Exactly.
I would like to say that very clearly. I saw, actually, to the point of quitting and the sunk cost fallacy, I saw some exchange on Twitter. It must have been like six weeks ago or 2 months ago or something like that, where somebody had recommended that somebody buy crypto. I think they bought, I can't remember which coin it was, but they bought it at like 50,000. And it was trading at the time at like 23 or something. And so
it's
they
probably
said,
Bitcoin based on the numbers you said.
Probably, I think it was. And so the person said that they had sold it, and somebody chimed in. I think it was maybe the original recommender who chimed in, who said, you don't do that, because then you're not going to be there for when it goes back to 50. And, so he was saying to him, like, don't sell, because essentially it's implied is now it's really cheap. And how are you going to ever get your money back? So I think that this is something that investors need to really understand. And to your point about, the problem is once something starts going down, there's all these rationalizations for why you should continue to buy or at least hold that have to do with it. It all boils down to, now it must be really cheap. The problem is, like, when you take something like dollar cost averaging, as you just said, you can either apply that rationally or it can become a rationalization, right? So there's a difference between rational and rationalization. And what we want to be careful about is using some of these things as a rationalization, which is just that we want to keep holding. Okay. And that's what you could kind of see in this exchange between these two people. But it's a perfect example of the sunk cost fallacy, right? The question should not be, well, you bought it at 50 and now, dude, you're not going to be able to get your money back, because that money is already gone. And the question is, if you take that 23, is the best place for that to park it back in Bitcoin? Like, if you were approaching that decision today, would you park it in Bitcoin, or would you take that 23 and, I don't know, put it in T-bills, park it under your mattress, put it in an ETF, index the Dow, whatever, I don't know, right? Like, what would you be doing with that 23 otherwise? But that's not the way we think about it. We think about things the way that this person was sort
in
of
relation to
chastising.
what you bought, right?
Right, exactly. And this is a huge issue. And it's one of the biggest problems with our failure to quit. And then what ends up happening is, of course, you sort of see the track of time. And I'm sure that people who held on to their NFTs are looking back on the situation, and there's a whole bunch of points. Oh, I should have sold then. Oh, I should have sold then. Oh, I should have sold then. And of course they didn't. And that's not to say, I want to be really clear. I'm not saying that if something goes down, you're supposed to sell. And nor am I saying if something goes up, you're supposed to sell. What I'm saying is, if you wouldn't buy it today, you're supposed to sell. And, by that, I mean that what you really have to think about, right, is in terms of, if I were to buy it today, would I, is to think about it as if it were a fresh decision. In other words, if I'd never owned Bitcoin, it was never part of what I did, I had never lost any money on it, I was just some new person who was coming to it, would I buy it? And if the answer to that is no, then you shouldn't hold it. So we can see where this sunk cost issue really creates a failure to quit in situations where you ought to. Now, Bilal, I want to just caution you of something, right? So let me just ask you this. Have you ever, like in investing, have you heard people tell you this thing? Because I assume, like people are aware of the sunk cost fallacy, right? Like they kind of, they kind of know about it. So have you ever heard anybody, or maybe you do this yourself, which is, totally understandable, where they say, well, the way that I deal with it is I actually do what Annie just said. And I think about, would I buy it today?
Yeah, I'm sure naturally I probably would think of it. Personally, and this is just me, so I'm speaking for myself here. The way I think of my own portfolio essentially is I have kind of like a barbell strategy where like 90% of what I have is in pretty safe things. And then I have like a small amount in more speculative things that I think might have a lot more upside. And essentially my rule is I'm only buying and holding for a very, very long time. And so that takes away all that timing the market and the kind of inconsistencies in my own decisions, because I know in a euphoric moment, I'm going to feel greedy. And in a time where everything goes down 50% like it did, in the last year, or more than that, if you're in crypto or something like that, or to be honest, if you're in Peloton stock or another tech stock, so it's not just
anything
crypto.
Tech, right?
Anything, yeah, or almost all the Great British Pound, so pretty much everything. So that's kind of how I play, and I also accept I don't know enough I'm not a professional investor, but I have a background in tech, right? So that is the part I know more than most average people. And I think about, where do I have information or like knowledge in things that maybe other people don't, but then even understanding my limitations there, because a lot of it is macro related. Right now, the price of Google stock is down, not because Google is all of a sudden a terrible company, it's because the liquidity in the market has gone away, and like we're going into a recession. So that's kind of where I kind of like try to take out the decision making part. And I just think, what would I hold long term? And that's pretty much long term index funds and, of individual stock of maybe like 3 or 4 companies that I think will be here in like 10, 20 years, and real estate. And then the speculative bet is on something like a crypto. So that's kind of how I personally think of it.
So, so let's think about that. I think that's really good, because that sort of gives us 2 answers to part of these problems. Okay. So the first thing that I want to be really clear with people about is that if you say to yourself, would I buy it today? It won't work. So I think this is really important for people who are, this is true whether it's investing or entrepreneur or business, because you can also do this with projects, right? Like you're mired in a project or you're developing a product and it's not going well. And you say to yourself, well, if I were to make this decision fresh today, would I start it? So it's a similar thing to, would I buy the stock today? Would I buy Bitcoin today? The thing I really want to caution people about is that doesn't work. So, and it doesn't work in this exact same way. So I assume you've seen a bunch of visual illusions.
Yeah.
Right. And they're illusions, right? So I can explain it to you. I can show you, like If
Here's
it's
a
just
spoon that goes in the water and it looks different. Is that what you mean by visual illusion?
or like have you ever seen like the Müller-Lyer illusion where there's two lines and one has arrows facing out and one has arrows facing in and one line looks shorter than the other?
Oh, yeah, I know what you're talking about.
Right.
Yeah.
So, but I can actually show you with a ruler
That they're the same.
the lines are the same. It's these little tails that are causing it to look different.
Yeah, yeah.
Okay. So you've seen that, right? That's the Müller-Lyer illusion. Now, if you've seen it and I now have explained it to you, I can literally hand you a ruler. I can say, Bilal, go measure the lines. And you go measure the lines. You're like, oh my gosh, they're the exact same length. And then you step back and you look at it again. What do you think you see?
You still see the same as before, right? Yeah.
Yeah, exactly. So you can't.
It's the perception.
You can't unsee it. So those are visual illusions, but sunk cost is a cognitive illusion. So even if you go to it and you say, and there's lots of science that shows that this is true, particularly from a wonderful person named Barry Stahl. And what he's shown is that, even if you know about it, it doesn't really help. Like if you say, like, I'm going to treat the decision as a fresh one, like would I start the project today? If I was starting today, is this where I put my, development time into this particular product? Would I buy Bitcoin today? That it's not going to help you. And the problem is so many people use that strategy to try to overcome sunk cost that they think they're overcoming it. So they have a lot more confidence in their decision, but the decision is no better. It's still affected by the fact that you've been on some sort of losing trajectory as you're facing that decision. So I want to be really clear about that. Now, you can do something like what you did, which is take the decision making out of it altogether and just say, I'm going to be someone who holds in the long term. The problem there is that even though that reduces the number of quitting decisions you have to make, you still have to make them. For example, if you're fully committed and now there's a new thesis that you would like to trade and hold for the long run, you have to free capital up. And we know from Alex Emos that we're very bad at that decision too. Like even that little quitting decision costs us a lot. So as an example with expert investors, these are people who are institutional investors. They are on the buy side where they're also holding for the long run, right? They're not high frequency traders. On the buy side, they're about 120 bips better than the benchmark. But when they actually have to go in and free up capital to go trade something new, to go make a new buy, they're actually about 70 bips worse than a benchmark, which would just be random from their portfolio. Okay, so even there, we see that people are quite bad at those quitting decisions. So the question then becomes like, all right, if just kind of knowing about it and trying to do this trick of like, it's a fresh start, let's do this fresh start, doesn't work. And if you can you're definitely reducing damage by sort of holding, just holding for the long term, but you're still going to have these decisions come up. The question is then, how do we actually solve for it? And the answer is you decide in advance. So here's the intuition that we have. And I assume you'll agree with this, that let's say that you are trading Bitcoin, right? And you're buying Bitcoin. I assume you have a thesis.
Yeah.
So you whatever the thesis is, you have some idea. You're saying, I'm buying this because this is why I think this is a better place to put my money compared to other things. So, for example, with Bitcoin, one of the things that I believe people thought was true was that it would be uncorrelated with inflation.
Yeah.
So it would essentially create a hedge to inflation,
like digital gold. Yeah.
So I'm not good. I just want to make sure I'm not misstating
No, that's
that.
definitely, that's definitely one of the narratives.
I never bought Bitcoin because I don't know enough about it. So, and I don't like to be in things that I really, really don't understand. So, but I understood that was the case. So you have some sort of thesis. Included in that thesis is this will be uncorrelated with inflation. That's part of the reason why it's a good thing to buy. Now, tell me if you share this intuition that if it's the case that you're buying it partly because you believe it will be uncorrelated with inflation, then if after the fact, after you own it, you discover that it is correlated with inflation, that you'll sell.
Yeah, if that was the only reason I had it. But yeah, so for example, in this real case, that is something that I thought was one factor. And now, given that new information where we are in a record inflation, that gives me less conviction in that narrative. And if I look at the factors I'm looking at for that decision, that is now not as strong as it was before. And therefore, I would probably adjust my thesis or the actions I take. But again, probably easier said than done.
Well, that's the thing. Definitely easier said than done, because here's the problem is that, and this is true, by the way, if you're talking about just sort of retail investors, or if you're talking about like PMs at very big companies, is that we all share that intuition. Well, if my thesis includes that it's going to be uncorrelated with inflation, then when I discover after the fact that it's uncorrelated with inflation, that it is correlated with inflation rather, then obviously I'm going to sell. Okay, so we all share that intuition, and that's true of anything, right? If I'm climbing up a mountain and a snowstorm comes in, clearly I'm going to turn around. If I'm in a job and some new person comes in who's super toxic, obviously I wouldn't stay in that job. I would go look for another. If I'm running a marathon and I break my leg, I would obviously stop running. All these things where basically the problem that we have as decision makers, and this goes back to poker really, is that when we make a decision, there's a whole bunch of stuff we don't know, and there's also luck, right? So as we enter into the decision to start something or buy something, we know that we know very little in comparison to all there is to be known. That's why we call it a thesis as opposed to a fact, right? Or a set of facts, right? So we have some idea. We've modeled the world in some way based on very limited information, and also luck might intervene. So the good news about this option to quit is that that's what kind of helps you with that problem, because you realize, well, I can buy it, but then when I learn new stuff, I can change my mind. I can start to do something, but when I learn new stuff, I can walk away from it and I can quit. So you go in and you say, look, here's my best guess. My best guess as I'm buying Bitcoin is that it's uncorrelated with inflation. So this will be a good inflation hedge. That's my best guess. But then you discover some new stuff. And what we think is, well, obviously I have the option to quit. When I find that thing out, I'll sell it. And what the evidence shows is that intuition is completely wrong. Like totally wrong.
Yeah.
That when we actually come up against it, we'll do things like a little bit of what you did. Well, it was just one piece of the puzzle.
Yeah.
Right. That's one way to do it. Right. Like, oh, sometimes we'll say, well, I didn't really think that in the first place.
Yeah, well, you kind of lie to yourself to, I think another example outside investing, a bit more on the personal side, is like in relationships, right?
Oh,
like,
gosh, yes.
And obviously because there's a lot of emotions and memories and, all sorts of like positive and negative toxic things going on at once. I think that's probably even one of the hardest things where, the example, if everyone's got a friend, maybe it's even ourselves, who've been in a relationship for too long, right? Like you see, oh, it's going down a bad route, and you're like, oh yeah, that person's like freaks out on me sometimes, but they are great for these reasons. And like going into that relationship, you might have said, if anyone ever did this, it would be a complete no-go. But once that's a rational, if you want to use that word, decision. But once you're in it, life is not rational most of the time. So I don't know if that kind of resonates with you as well, but just I think that's something we all fall into.
I talk about that in the book. So for sure. So if it's the case that we're not going to pay attention when we see it, then what we have to do is write it down in advance. So an example with Bitcoin would be, and it feels like a distinction without a difference. Like I completely understand that, but you have some sort of thesis, and part of your thesis is it's uncorrelated with inflation. This is one of the reasons why I'm buying it. So at that time you say, so if I discover that it's correlated with inflation, I will do X. So literally write it down, say here, in other words, I have a belief that I'm going to pay attention to the signals that I might see in the future that will tell me that things aren't going well and I should walk away. But now that I know that's not true, what I'm going to do is I'm going to write those things down. And I'm going to say, I'm investing in this coin. But if I see certain things in the future, then I will actually walk away from it. So one of them might be as simple as a loss limit, right? So there's some point at which it goes down a certain amount that you should convince yourself that you're going to be a bad decision maker about it, or maybe your thesis wasn't right in the first place and you just walk away. But one of them, you can also talk about the fundamentals, right? So if I see that it's correlated with inflation, when I see that, then I'm going to sell, because that's going to make me feel like I don't actually understand this coin in the way that I thought I did, because it was so central. It's such a central piece of the discourse around these coins, that if I see that, then I'm going to go, oh no, right? And that now I don't think that I understand it, and I have to sell.
Flag.
Red flag.
And actually, just Annie, just to add, on the flip side, that's on the way down, but also on the way up is very important too. Like I have basically have set points of certain investments where I've predefined, no matter what is happening in the world, like I need to take off a certain amount of money at this stage, because obviously I can change my mind if there's completely new information that changes everyone's opinion. But like, for example, a global pandemic, right? Something that we've never experienced and could never have modeled for, essentially. That, of course, would be something to like be like an event that you couldn't have thought about. But if the rules of the game were as kind of planned, and, you know, looking specifically at crypto again, since we're talking about it, if you look historically, there have been these, you know, massive bull and bear markets, like normal, you know, the economy as a whole, but specific for crypto is even more so the case, because there's something called the Bitcoin halvening. And so that is generally been like correlated to that. So that would be something for me, which my learning from the last couple of years has been, I need to be very disciplined about some of those things as well.
And don't leave the decision to in the moment, right? Like as much as you can think in advance. So like a simple example of this type of doing this is, so when people are climbing mountains, they have something called turnaround times. So when you're going up Everest, like let's say you're at Camp 4, which is where you leave to go to the summit. If you're climbing, if it's summit day, your turnaround time is 1 p.m. So what that means is that no matter where you're standing on the mountain, it doesn't matter if you haven't gotten to the summit yet, you have to turn around at 1 p.m. Or earlier if you figure out you can't get to the summit by 1 p.m. And the reason for that is that it's really too dangerous to descend certain parts of that mountain in darkness, particularly something called the Southeast Ridge, where if you slip, you'll either fall all the way down into Nepal or all the way down into Tibet, neither of which I assume you want to do. And so they've set this in order to keep you safe. Now, the reason why they set that in advance as you're departing is because they know you're not going to be particularly good at making that decision as you're in the shadow of the summit, right? Because the summit is too big a pull. And part of the problem, one of the things that we need to realize when we talk about this idea of being in the losses, like that idea of feeling like you're losing, it's not just like actually losing, like I bought it at 50 and now it's at 40. It's also a cognitive phenomenon. So if you're 300 feet short of the summit, you feel like you have like you're losing, even though you've climbed like 29,000 feet, right? All of that doesn't count, because those types of destinations, those goals are very pass-fail in nature. So it's what they recognize is it's very hard to turn around when you're 300 feet from the summit. By the way, 300 feet from the summit is still hours, right? Like it's a long way away from the summit. It feels very close, but it's going to take you a long time. It's not like you just like skip on up and you're fine. But it's really hard when you're that close, because you feel like you're selling at 40 when you bought at 50, but like bigger, right? Like a lot more effort, a lot more time, a lot more of your identity, a lot more spent on it in order to what you feel like is fail. So even if you're short of the summit, if you keep going, you have an opportunity to turn it around. In other words, you have an opportunity to maybe make it to the summit and not experience that failure. And when you turn around, that's when you say for sure, I can't make it. It's when you actually have to like metabolize that loss and say, okay, I'm just losing. In the same way, if you sell at 40, that's when you say I lost $10, right? And those moments are incredibly hard for us. So the reason why they set turnaround times in advance is in recognition of the fact that you're going to be terrible at making that decision in that moment. I mean, really bad at it. So if we at least set this thing, which is sort of like a loss limit, right? Then we can at least increase the probability that you're going to follow along and not actually die. And there are, I talk about one of the examples in Quit, but there are examples of climbers who literally have saved their lives, who have lived because they followed the turnaround time. So are you going to be perfect at it? No. If you write down in your journal, here's my thesis. One of the strong pieces of my thesis is that Bitcoin is uncorrelated with inflation. and then you write down kill criteria, which is what I call them. Here's a kill criteria. I find out Bitcoin is correlated with inflation. And then you write down what you're going to do about it. Maybe you're going to sell at that point. Are you going to be perfect at it? No. Are you still going to rationalize and maybe hold? No. Are you going to sell less than you said you were? Maybe. All of those things might be true, but the point is you're going to be more likely.
Yeah, you've got a plan. You've got a plan for it. Yeah, completely.
Yeah.
And I think just in general, like I'm just thinking in my own personal life, like things that I've done in a positive way and stuck to, like let's forget like investing for a minute, just like even like health goals, like eating in a certain way, going to the gym, playing a sport. Like the thing that made me stick to it was like a sport. I literally schedule it, put it in the calendar, I block it out. And it is like, no matter if it's 9 a.m. in the morning, I'm going to feel like, oh, I don't want to do this right now, but it's already kind of paid for and like I need to be there. And there's other people there that I'm committed to being there at the same time. And that seems like such an obvious thing, but we all have those examples in our own personal life, but then we ignore it in, these big moments that matter. You mentioned the Mount Everest example. And I know in the book you've talked about some other examples that are outside of, not everyone's climbing a mountain, but I know you've talked about like the Slack founder and Richard Pryor as well. So yeah, could you talk about a few more examples of people that did actually do this in a good way?
Yeah. So here's the problem with quitting, is that quitting is an expected value problem. So expected value is just a forecast of over time what would you expect to make. So this is, a really important concept in poker. What I think about is if I bet $1, am I going to get a positive return on it in the long run? So obviously, for any hand of poker where I bet $1, I either lose the whole dollar, right? Because I lose the hand, or I win everything in the pot. But for any particular hand, actually, I only get a percentage of the pot, theoretically speaking. So let's say that you and I both put all our money in the pot, and there's $100 in the pot, and I'm going to win 60% of the time. My expected value is $60 over time, right? So because 60% of that pot basically belongs to me, and 40% of the pot belongs to you. And if I know that, then I can figure out if I'm winning or losing by how much of that I contributed, right? Am I positive or negative to that decision? So if 60% of that pot belongs to me, then I can think about how much did I bet. So if I had to bet more than $60 in order to get that 60% of the pot, then that's negative expected value. If I had to bet less than $60 in order to get that, then it's positive expected value. Is that clear?
Yeah, that makes sense. Yeah.
Okay. So like when you're buying Bitcoin, it's an expected value decision. What you're saying is that when I buy it, or if I buy a stock, that when I put this dollar into it, I believe that over time, I will be making money on this choice, not losing money. In other words, the gains outweigh the losses, long run. And that's true for your time and effort and attention as well. So if you're investing your time and attention into a project, you believe that that's positive expected value, particularly in comparison to other things that you can do at that time. If you decide to learn to play the trombone, you're saying, I think this is not going to increase my happiness. It's going to fulfill me. It's going to enrich me. On its own, and also in comparison to other activities that I could be using that time for. So this has to do with these expected value decisions. So the problem when it comes to quitting is that expected value, as you can tell, is theoretical, and it's future, right? You're thinking about what's going to happen in the future. And what that means is that a lot of times when quitting is the correct thing to do, in fact, most of the time, it's not going to feel like anything particularly bad is happening in the moment. So if we go back to the Everest example, if you're on the mountain, and this actually happened to 3 climbers, Stewart, Hutchinson, John Taske, and Luke Kositsky, they're on the mountain. It's 11:30 a.m. They've got lots and lots of oxygen. They're in good shape. They don't have frostbite, so on and so forth. And they figure out, because remember the turnaround time is 1 p.m., they figure out it's going to be 3 hours before they get to the summit. So they just do the calculation. So they're looking ahead into the future. Nothing bad is happening to them at that moment. They are fine. But they look ahead and they say, oh, it's 11:30. It's 3 hours till the summit. We're not going to get there till 2:30. That's after the turnaround time. So I think we should turn around now, which they do. And it's probably not surprising you haven't heard of them, because that doesn't seem like something you'd make a movie out of or write a book about. Although they did, because they were part of the expedition from Into Thin Air. But notice that it doesn't seem that remarkable, but it's because it doesn't feel like dramatic enough to us if nothing bad is happening to them in that moment. But that's going to be the case, right? So the right time to sell something is not after you've lost all your money. It's long before that, when nothing looks that bad. You're just kind of looking ahead to the future and figuring out that something doesn't look good in the future. So this brings us to Stewart Butterfield. So Stewart Butterfield is a serial entrepreneur. He had founded a company that was trying to create a online world building cooperative game. This was back in the early 2000s. And with the dot-com crash, just found it was impossible to raise money for it. But he had developed they just ran out of money. So they were forced to shut the company down. So at that point, something dire has already happened, right? But they can't raise money. But they did recover from that. There was a photo sharing function in the game, and that became Flickr, which he sold for $25 million. So that was a reasonable exit given those times. But he didn't want to ever give up his dream of building an online cooperative world building game, a multiplayer game. So he founds Glitch. This is in the late aughts. He founds Glitch, which creates a game called Game Never Ending. And Game Never Ending is just absolutely a critic's darling. It was described as Dr. Seuss meets Monty Python. It was beautiful. And it really did develop like an incredibly hardcore base of fans. They got to about 5,000 users who used the game 20 hours a week or more. So obviously those are like you're paying, they're paying. So that's where your money's coming from, is those 5,000 people. So that sounds pretty rosy, except the problem was that for every customer they acquired who would play for 20 hours or more, somewhere between 95 and 99 people would come visit the game, play for 7 minutes and leave. So you just clearly have this issue, right? Which is like, we've got to get this in front of so many people in order to get one person who like is really into the game. But the signs were relatively positive. They Andreessen Horowitz and Acel, for example, had invested in them. They had $6 million in the bank. So things look pretty good there. The critics believe in it. The core gaming community, there's this diehard user base that loves it. And so what they decide, his co-founders and investors decide, is that they'd only been doing word of mouth and PR marketing prior to this. They're now going to go wide, and they're going to start doing paid marketing. So they do this huge marketing push. This is right in October and November of 2012. And they do this huge marketing push to try to acquire customers. And it actually works really well. They're acquiring customers about 6 to 7% week over week, which is amazing. Right?
Yeah, very good.
Yeah, really good. So they get to November 11th and 12th that weekend, and they have their best week of user acquisition yet. And it's, Stewart Butterfield goes to bed on Sunday night, and he finds himself like unable to sleep and like really restless and super stressed out and anxious. And he wakes up the next morning and he emails his co-founders and investors, "I woke up this morning with the dead certainty that Glitch was over."
Wow.
And he shuts the company down. Okay.
Damn.
Right. Wow. What's going on? So by the way, that's what his co-founders and like investors were like, WTF, what are you doing? We just had this amazing 6 weeks. So this is what happened was he was kind of doing the math. He was making an expected value calculation. And what he realized was that if they were to continue to acquire users at the rate that they were currently doing so, it would be 31 weeks until they broke even. Now, he realized that was an absurd assumption, because at some point you've saturated the core gaming audience, right? So you know that CAC is going to start going up. It's just going to cost more and more to acquire each customer as you go along. And you're going to start like recycling those ads in front of the exact same people who've already tried the game, who don't want to do it. And he just knew there's no way that was sustainable growth. So it was an incredibly optimistic forecast to say that you were going to get to break even in 31 weeks. At which point he just realized it's not a venture scale business. And once he realized it wasn't a venture scale business, he felt a real obligation, particularly to his employees, to shut it down. Now, notice that this kind of turns one of those rationalizations on its head, because what people will do in that situation is they'll say, I owe it to my employees to keep going. They've believed in the project, right? They've put so much of their time and energy and heart into it. I have to keep going. That's just very classic sunk cost fallacy. What he realized, again, being the great quitter that he is that his employees were working for very little cash comp and mostly equity. And the minute that he determined that that equity wasn't worth their time, he needed to let them go to go do something that would be worth their time. His co-investors, his investors and his co-founders were just very confused by what had happened. He explained the math to them. It isn't clear if they were sort of on board, but what was clear was that if Butterfield didn't want to do it, there was no point. So they shut it down. What I think is interesting is if you talk to Stewart Butterfield, he'll tell you that he's actually a little embarrassed because he says he knew 6 weeks before that there was a problem and that they should have shut it down and they should never have spent all that money on the marketing push. But he didn't want people to think exactly what they ended up thinking anyway, that he just got bored or he was capricious or something like that. Now so that's a great example of quitting. Like, it's not a venture scale business. The equity isn't worth it. I shouldn't be making my employees work for equity going forward, particularly because they're so brilliant. That isn't worth it, right? I should return the money. I should return the capital to the investors so that they can invest in something that is going to change the world and is going to be amazing, because this isn't it. And he shuts it down. So that is a happy story. Now, as it turns out, there's a coda to the story.
Yeah.
Which gives us another lesson about quitting. So here's a really important thing for people to understand. It is very important to quit when you're on a path that you turn out isn't worthwhile, not just because it's causing you to lose ground, period, but because when we're pursuing something, whether it's a project or whatever, or when you have an investment on, you're less likely to be exploring the other things that you might be putting that time and energy, attention, money into. So it creates a myopia where you just don't see the other opportunities that might be available because you're so focused on the thing that you're doing. And this is exactly what happened with Stewart Butterfield, because he shuts Glitch down. So he quits it. And within 2 days, he started a new venture.
That's wild. I didn't realize that.
Right. But it's something that's already under his nose.
Yeah.
So at Glitch, they had been using an internal communication tool in order for teams to be able to talk to each other that combined like the best of sort of email and instant messaging and so on and so forth. But like literally, it didn't even have a name. It was just kind of the way that they communicated to each other within the company. And as soon as he quits Glitch, he's like, oh, you know what? People kind of really like this tool. Maybe this would be a good product to develop. So he decides to give it a name, Searchable Log of All Company Knowledge. And its acronym is Slack. And obviously we know what happened with Slack. I think
the rest is history. Yeah.
Yeah. $20 billion or something to Salesforce. So
crazy.
But so here's the thing is that was there the whole time. That's the thing that you need to understand. It was literally under his nose the whole time, but he didn't see it as an opportunity to create a venture scale company because he was focused on this other thing. So think about what an amazing story this is. He gets to that decision really early that Glitch isn't going to make it. That frees up his time and attention to go explore. And then he sees what was already there, which he literally couldn't see before. Oh, I've got this thing that might be really cool. And it's Slack.
And the opportunity cost of continuing down that path he was on, which looked okay and doing well to other people, was eventually what was Slack. So that was a beautiful example that perfectly illustrates this idea. A kind of follow-up question to this is, like, I know you say in the book that grit and quitting are actually, like, we think of them as two opposite things, especially in the entrepreneurship world, because 99.9% of entrepreneurs you meet, they're saying the same stuff. Like in interviews, they're saying, well, everyone thought I was down, and then I figured out a way, and then we got the team together, and then we figured it out. When everyone else thought we were going to stop, we kept going. And to a certain extent, like there is a part of that, right? In terms of there's barriers and there's a level of pain that entrepreneurs specifically have to go through that most people just don't appreciate and realize because they're not in that situation. So I'd love to go into that a little bit more. That kind of the idea of grit on one side, which there's literally books written about grit,
which people should read, by the way.
They're great
yeah. Books.
Yeah, exactly. But then we think of quitting on the other side of the spectrum, but you're saying they're actually both on the same side of the coin, so to speak.
Well, I mean, look, anytime you choose to stick with something, you're by definition choosing not to quit. And anytime you choose to quit something, you're by definition choosing not to stick. I think the problem that we have is that we think of one thing as good and one thing as bad, right?
Yeah.
Like grit is a virtue and quit is a vice. So quitters are losers. They're failures. They're weak-willed. But like the heroes of the story are the ones who stick it out. I mean, that, right? And also like, just think about parenting, right? Like I want my child to build character, so I'm not going to allow them to quit. So sticking with things is literally like a way to build character, at least as far as we think about it. So look, here's the thing is that the key is, since grit and quit are the same decision, it's understanding the difference between things that are hard but worthwhile and things that are hard but not worthwhile. So that's what we have to do. That's that expected value.
Could you say
decision.
that one more time, just because I think that was important?
We have to tell the difference between things that are hard but worthwhile and things that are hard but not worthwhile.
Yeah, that's perfect.
Right. And what we think is that we like, we'll do these things like what I owe it to my employees or my investors or whatever to just stick it out. And the problem is, no, you don't. Right. Because if the path that you're on is not worthwhile, you actually owe it to them and to yourself, by the way, because life is really short, to stop doing that so you can go do something better. So the key is to tell the difference between the two. That's the key. And that's where these two things really come into play. Kill criteria, right? When you go in, you really have to think about, and that's true whether you're thinking about not just, should I return the capital to my investors and shut it down? But also maybe should I stop developing this product because I'm just not finding product market fit and I ought to quit that and go switch to something else, right? So we have to realize there are small acts of quitting that are happening all the time. You start a project, a strategic initiative, you're thinking about a particular way to message the product, so on and so forth, where those are all things that you may end up quitting while you keep the company going. And then sometimes you actually make the choice to shut the company down. So the way that you get to that is through really deft use of kill criteria to say, okay, as an example, like I'm starting this endeavor, how long is it going to be, or how long do I have before I figure out if I have product market fit? What do I need to see in terms of customer acquisition, in terms of revenue growth month over month? What are those things that are going to tell me that this is successful? Now, I know that there are examples of people who, were on the edge of death, who had raised millions of dollars and were down to their last 50,000. And they went and they stuck it out and recoded things or whatever and ended up being successful. But that is rare. This is a very good example of survivorship bias.
Yeah, I was just about to bring that phrase up. Yeah.
Yeah. So look, just because somebody did it doesn't mean that you should do it, because it doesn't mean that grinding yourself down to your last 50,000 only to recode the product at the last minute is a way to be successful, right? It means it worked out for somebody in the same way. And actually, when you asked me in the beginning about poker, that's the problem with people who say, oh, that hand would have won, so now I'm going to play it in the future. Because what's true in retrospect is not true prospectively, right? I don't care that your 7 deuce would have made a full house. So you saw that one time. That doesn't mean you're supposed to play it every single time thinking that that's going to happen to you enough of the time to be profitable. And that's the thing that we have to remember, right? Yeah. So kill criteria are a way to benchmark those things out. And then the other thing is to get yourself a quitting coach. Sometimes that's your investors who can really help you through these decisions. So one of my favorite examples of this is really Ron Conway, who is a founder of SV Angel, probably the most successful angel investor there is, I think. And one of the things he really prides himself on is helping people to quit, because he's very sensitive to this idea that, look, Founders and entrepreneurs are incredibly gritty, super, super, super smart people who could really be changing the world and changing their own lives. But life is too short for somebody who has those qualities to be spending any time on something that clearly isn't working out. So basically, he sort of combines this idea of like coaching people to this decision with really deft use of quitting kill criteria, rather. So this is what he would do. He'd be like, Bilal, let's agree that things aren't going very well. Right. And you'll be like, yes, I agree. Because, those are just the facts. Yes, I agree. So he'll say, like, do you want to consider maybe we should shut it down and move on to something else? And Bilal, you're like everybody else. And you say, no, I know I can turn it around. Because that's what we do in that moment, right? When we're facing it. I know I can turn it around where, the next version of the product is about to get pushed out. And I know that users are going to love it. Or, I'm just on the brink. I'm in the middle of talking to Walmart about a huge purchase order, and that's just going to make or break the company. And if I can get that's going to turn it around. So you have all these things that you say are on the horizon. And what he does is actually really smart, which is, even though he can kind of see what's going on from the outside really clearly because he has so much experience that he can see that this isn't going to turn around, he doesn't disagree with the founder. He says, yeah, I agree. I think you can turn this around.
That's smart.
So, yeah. So he doesn't, he just says, yeah, of course, I think you can turn it around. So how long, right? Like, how long do you think it's going to take for you to get this purchase order? Or how long is it before the next version gets pushed out and you're going to actually see whether users really like it or whatever? So let's say that it's 2 months. Okay. So we're going to know within 2 months. So he says, great. Okay. So you think you can turn this around. We're going to start seeing that you've turned it around within the space of 2 months. So now let's sit down together and write down, what are the things that we're going to see in the future? What are those signals going to be that you've actually turned it around in 2 months? Okay, so maybe it's going to be you secured the purchase order, or maybe it's going to be like you pushed out the new version of the product and users started growing 5% week over week or whatever. You figure out whatever that is. Could be how much revenue you generate in the next 2 months, maybe key hires that you make. I don't care. So you write down, here's what it looks like in 2 months. He says, great. Now let's talk in 2 months. We're going to reconvene. And in 2 months, if you haven't hit these benchmarks, if we don't see these signals, then can we agree that we need to talk about shutting it down?
Yeah.
And what this allows you to do is get the person out of the moment of the decision, because that moment of that decision is so hard. It's the moment that you go from failing to having failed. It's the moment you say, I've lost. I can't get it back, right? Like that's it. There is no recovering this. And what does that mean for all the time and attention and money and how much I'm identified with this and all the things that I built. And that moment is really hard, but you can do it better if you look into the future. So that's what he does. And then he goes and he revisits in 2 months. And if they haven't hit the benchmarks, they're much more likely to shut it down. And if they have hit it, great. Right. Well, then you go on and you continue to develop and you continue on with the project. So I think that essentially, if you can think about it, what he's doing is trying to help people understand what the difference between hard and worthwhile and hard and not worthwhile is, by actually getting really good definition around, what does it mean? What does success look like here? Right.
Yeah.
And not success like you're a $1 billion company, success like, well, in order to be a $1 billion company, you have to have raised an A. Right.
Just progress in the right direction, I guess.
In the right direction.
It doesn't have to be the 10 out of 10 thing in the future, just like moving towards that next kind of milestone.
Right. And that's the thing, Bilal, that's really important, is that what would happen if they were left to their own devices and they didn't actually write it down? Like, let's say they said, we need to generate 200,000 in net new revenue, in the next quarter. So let's say that was what they said in order to know that they were on track. So now they generate 110,000. We know what's going to happen in that case if you haven't actually written it down. They're going to say, look at all the progress we made. Like, obviously, we're almost there. We've almost broken through. And by actually setting this down, in advance, it lets you see, like, no, that isn't really progress. It's way too far away from where you said that you had to be.
Yeah.
right? Or 75,000 in revenue. Like it's just too far away. If it were 180 and you set the goal, all right.
Yeah,
Look,
you're
I'm not going to
close.
argue with you. That's in the
Yeah.
range, but like 75, 120, whatever. It's like, it's just too far away from where you said you would be. And you have to start to listen to those signals. And then he actually does the coaching that I think is important, which is, that then they usually do invoke, like, I owe it to my employees. And what he says
Okay.
is it's not just that your life is too short to be spending your time on something that isn't worthwhile, but your employee's life is too short as well. And you have to let them go to go do
Yeah.
something that amazing, with their time.
That's a great, I mean, I love that approach, especially as someone who's an investor, someone who's partnering with entrepreneurs. I will say, I was listening to everything you said there, and I was thinking my primary lens is normally the entrepreneur's point of view. And just knowing all the people I've met, even my own on a small scale, things I've done, most entrepreneurial people are people who have been told kind of all their life, like, you can't do this, and you found a way to do it, right? And you kind of got away with it. I hate that phrase, but so many times that becomes your new behavior. Maybe getting away with it is the wrong word, but you kind of keep proving to yourself, and you're essentially someone who believes in the unbelievable. Like, there's something that doesn't exist in the world that you're gonna bring everyone to this vision. And so I think as a characteristic of that sort of person is even more important to have that kind of balancing force of someone
like, you're totally gritty by nature. And that's why I say, like, don't get any coach. Like Ron Conway, he's there in it with you, right? Like, he invests in founders that have that vision, where other people might say that's impossible. He's right there with you. He believes in you, right? He has shepherded lots of companies through all sorts of ups and downs. So he understands the difference between hard but worthwhile and hard but not worthwhile. He gets it, right? So that's why when you're thinking about who is going to be the quitting coach, it has to be somebody who, particularly when we're talking about entrepreneurs, right? Who does see the unseeable, because they invested in you in the first place. They saw your vision. They believed that you could do it. And now signals are strong enough that they realize, like, this is going to be bad. And notice the thing is, he doesn't ask you to shut it down today. He says, let's define what success looks like, because I'm not going to argue with you that you can't turn it around. I'm not going to argue with you that you don't see something that maybe I'm not seeing. But let's talk about what the real world consequences of you seeing what I'm not seeing here are. Let's figure out what those are. And like, from his perspective, maybe, if he were king of the world, you would shut it down today. But what he's doing is, maybe you shut it down the next quarter, at the end of the next quarter, and that's 3 months from now. And instead of continuing on until you burn through all the capital and it's a year and a half and you can't raise a round, and that's now a year and a half that you could be spending on some other great idea. And that's something that entrepreneurs need to realize, is that the very nature of the way that you view the world and your grit means that don't waste your time.
Yeah.
Like, don't waste that on something that isn't worthwhile.
Stay true to what you originally were trying to do in the first place.
Right. And if it's not working, free the time up to go build Slack. Right.
Yeah,
like,
completely.
That's the thing, is that don't get so endowed to the one idea you have, as if you drop that, you failed. Because you have to realize, like, no, you need to take the way that you see the world and the grit that you have and how you can look at the world differently than other people, and apply that to something that is going to change the world. And when you figure out that the thing you're doing isn't, free your time up. Because that's what's going to allow you to go change the world. And that's why, look, for as many stories, and this, of somebody who started a company and got down to their last 50,000 and kept going despite that and turned it around, which there's like one or two of. What you actually find with most entrepreneurs is that they're serial entrepreneurs, and they get the big success after trying a few times. Because your first idea isn't always going to be the one that hits. In fact, it rarely is going to be. And investors love investing in serial entrepreneurs, people who tried something and failed, maybe multiple times. And this is like their third or fourth company, because then they know they've been there. They know what the mistakes are. They know how to actually execute on their vision. And those are the people who end up actually hitting, right?
Yeah.
Because they've quit and they've learned from that, and they've gone on to the next thing. So also another thing to understand is, like, we have this vision of entrepreneurs as 22-year-olds. But the average age for people who actually found companies that are that successful, I think, is now like 40 or above.
Yeah, I think it's like 42 or something like that. And
Right.
you've normally had, it makes a lot of sense, right? Like you've had real world experience. There's only, the survivorship bias you mentioned before of like Mark Zuckerberg, Evan Spiegel, and like
Right.
a
And then you
few
think, oh,
very young
that's what they
people.
are, but it's
Yeah.
not what they are. And
But the
trust me,
distribution is a lot more
that's right.
broader
And the
than that. Yeah.
42-year-old, the average 42-year-old who's creating a unicorn has quit a billion things. They've
Yeah.
failed a billion things. And I
Yeah.
don't think quitting is failing. So I don't think it's really the right word. It's just the way that we talk about it, because they've been there and they've done that, and they want to do something great, and they keep at it and they keep trying. So the question becomes not so much, is it bad to quit the particular product that you decided to develop, or is it bad to quit the vision that you have, that you can become a world-changing founder, right? And those are two separate things, because if that's your overall goal, is that I want to found something amazing and I want to make the world 10x better or whatever, I'm not telling you to ever quit that as a goal. I'm saying, if you've started a company that is not doing well and your goal is to make the world 10x better, you are slowing your progress down by not quitting. And that's the thing that we miss, is that if you're doing something that isn't going to get you to where you want to go, it's game never ending and glitch, and you can see the writing on the wall that it's not going to get you to where you want to go. Every extra minute past that realization that you spend on that project is slowing your progress down toward actually creating 10x change.
Yeah.
Because that means that you can't go and do something else. It is stopping you from being able to go do something else that would get you to where you want to go faster. And that's the thing that people need to realize, is that quitting well, when it's warranted, when the context is correct, will get you to where you want to go faster. Just as being gritty when the context is correct will also get you to where you want to go faster. But notice that word context. It matters what the context is.
Yeah, completely. Oh, thank you so much for going into all of that. I know there were so many other things we didn't even get to, but I'm just going to call out really quickly a few things that stuck in my mind that I'm going to keep with me. Quitting on time feels like it's too early. You kind of talked about that a little bit earlier.
That's with Stewart Butterfield. You can see that, right? Because again, nothing bad was happening at that moment. They had just gotten sort of they had acquired the most customers in one weekend that they had ever acquired. And certainly to the other people around him, it felt too early, but it was exactly on time because he saw it.
Yeah, completely. And then the other thing you just alluded to there, which we didn't get to go into in too much detail, but people should check out the book and read about this, The Dark Side of Goals. Every goal needs an unless, which is kind of what you were just talking about there. And then the tools or strategies to become a better quitter. You mentioned the kill criteria, quitting coach. There's two more in here, which we probably won't get a chance to talk about now, but people should go and check out the book. Monkeys versus Pedestals, Mental Model, and Divide and Conquer. But yeah, so you're going to have to go check out the book to get all of that.
Let's just do a quick Monkeys and Pedestals, because I have a couple of seconds.
Let's do that.
So this is actually a really important mental model for entrepreneurs. And it comes from Astro Teller, who is CEO of X, which is the in-house innovation hub for Google. And obviously their charter is 10x better in 5 to 10 years commercialization. So they're really trying to do things that are world changing, obviously investing at the earliest stages because they're an innovation hub. So he's very aware of these issues of, sunk cost and how do you get to know quickly, NO quickly. How do you get to say no quickly? And so he developed his mental model to really help with how do you approach projects to get to the quitting decision as fast as you possibly can, and to also reduce sunk costs, right? To also reduce that debris that we accumulate that makes it really hard when we're in it to actually walk away from things for fear of having sort of wasted all our time and whatever energy that we've put into stuff. And the mental model is called Monkeys and Pedestals. So it just goes like this, Bilal. So imagine that you've decided your entrepreneurial endeavor is going to be to train a monkey to juggle flaming torches while standing on a pedestal in a town square. Right. So like you're going to stand in Times Square or at subway stop or something. You're going to have your monkey doing this. I assume people will give you a lot of money for this.
Yeah, I'll be a show to be They'll be getting some dimes thrown my way either way.
That is right. So here's my question to you. If you're approaching this project, what should you do first? Should you train the monkey to juggle the flaming torches, or should you build the pedestal?
Okay, good point. Yeah. I have no idea, but yeah.
Yeah. So, well, so here's what Astro Teller's insight is that you should always train the monkey first. And the reason that you should train the monkey first is because if you can't train the monkey, there's no point in having the pedestal.
Oh, got it. Okay, that's the more important. Okay, got it.
Basically, you can think about what's the bottleneck, right? Like what's going to unlock the system. And the bottleneck, the thing that you don't know if you can do is train the monkey to juggle the flaming torches. But you do know you can build a pedestal. And at minimum, you know you can turn a milk crate upside down.
Yeah, okay.
So what's the point of working on the pedestal if you haven't trained the monkey yet? That's his point. So at X, they approach everything what's #monkeys first, which is we have to try to prove out the hard thing before we build any pedestals. So if we're going to build any pedestals, it has to be in service of trying to get this information about whether we can do the hard thing, right? Because if we can't do the hard thing, there's no point in the other stuff. And not only that, but if you build the pedestal first, you're now accumulating sunk costs, right? You're putting time and energy and money into building something that you own that's going to make it really hard for you to quit because you're going to feel like you wasted your time. So it creates the illusion of progress toward a goal when you already know you can build the pedestal. It's like, and this is true like with people who, in particular in software, right? Like you already know you can code it. So if you're building the code, before you figured out if you've like gone and talked to customers and just said, would you buy this thing? Like no demo, just like, is this something you might be interested in? If you've written a literally a line of code before you've done that thing, it's the illusion of progress because you already know that you can code it, right? It's a good example of that. So here's, I think, a great example of this monkeys and pedestals problem. So Astro Teller got pitched the Hyperloop at some point. So, that's like the train and the pneumatic tube that's supposed to get us places really, really fast.
From New York to LA in like an hour or two or something like that.
Like that, right? So he got pitched the Hyperloop. And they then did a monkeys and pedestals exercise on it. And what they figured out was that there were two monkeys. So basically what they do is they go in and they try to identify what the monkeys are. What are the hard things that might be standing in our way? And in this case, they identified two main monkeys. The first was a regulatory one, which was just, you're going to be going through all sorts of different townships, different states, different municipalities. And it's just like a regulatory nightmare in terms of like figuring all that stuff out. And as he said, like, we're Peter Pans with PhDs. We're not like, we don't know anything about regulations. And this seems like a really hard problem to solve. And then the second thing that he recognized was that in order to really prove whether you could get people on and off the thing safely, so that's a monkey, right? You would have to get the train all the way up to speed, because anything less than that, like if you get it a third of the way there, it doesn't really tell you whether at those high speeds you can get it to stop and start safely. You'd actually have to get it all the way up to speed. So those are the two monkeys: is can you get the people off and on safely? And can you solve the regulatory problem? They didn't even get to talking about the regulatory problem because they realized that in order to figure out if you could get people on and off safely and get that, you'd have to get the train up all the way up to speed. And in order to do that, you'd basically have to build the whole thing. So, and obviously all like the technology in terms of the track and the tubes and all that stuff, those are pedestals. Like they know that they can build it. So they don't want to build all of those pedestals where they're not even gaining new knowledge because they already know that they can do that in order to find out millions and millions and millions of dollars later that they can or cannot get the people off safely. So they rejected the idea. Do you want to take a guess how long it took them from the pitch to rejecting it was, since they applied monkeys and pedestals?
Was it very quick?
How quick do you think?
2 weeks?
15 minutes.
Oh, okay.
Okay.
Okay, I love that because it's just straight away you can dissect the two parts of it.
Right. And notice this is the opposite of how people approach projects. Because what do people always say? What's the low-hanging fruit?
Yeah.
right?
Yeah.
And low hanging fruit is pedestal. So you have to do low hanging fruit at some point, but never do it until you've solved the monkey. All right, so they reject it. Now Virgin ends up developing it. They decide we're going to do the Hyperloop. There was just an article, I think it was last week, in the New York Times, which said Hyperloop running into trouble. Do you know what the two bits of trouble that they run into
The
are?
two monkeys.
Yep. They're having problems with the regulations. It's just a nightmare. But then here's the other thing. They've only built enough track to get it up to a sixth of the speed.
Yeah.
And they said, well, we sort of consider that to be a safety test, a sixth of the speed, which of course it's not. And so now they're butting up against these two monkeys, and it looks like it may actually die. And this is, so notice, Astro Teller spent 15 minutes of his time, and Virgin has spent, I mean, millions of dollars. I might be able to find out exactly how much they've spent. If you hold on just 1 second.
Yeah,
Let me
yeah.
see.
It must be in the tens or if not hundreds, no? Because there's
I don't actually have the amount of money that they've spent, but it's a lot.
A lot of time
and
either way.
All they've managed to do is a 500-meter test track that got employees to go 107 miles an hour, right? And they said at the time that proved that it worked, but of course that didn't prove anything. I mean, that was the point of what Astro Teller said. So I think this is such a good example, right? Like you have one company that spent 15 minutes because they approached the problem the right way, and this other company that's just now mired, and it's going to be really hard for them to abandon it, even though they've discovered these problems. And this is, when we think about public works
projects. That's called sunk cost fallacy coming in there.
Right.
Yeah.
So, and this has happened with like the California bullet train, where the original budget for that's just high-speed rail to connect San Francisco to LA, basically. The original budget was $33 million. They started building track on the interior of the line, which doesn't address two really big mountain ranges, one to the north of LA and one to the south of San Francisco. Once they sort of realized, and this was 8 years in, that those mountain ranges existed, the budget exploded at that time to about 80 billion, but they weren't sure if that was going to be enough. Today it stands at 105 billion. They still don't know if they can get the track. They can actually safely build track through those mountain ranges. And in the meantime, they're building two other sections of track that are on flat land. And they're just not giving it up, right? And you can, it's like if they had just monkeys and pedestal the thing, they would have gone, there's two mountain ranges. Those are really hard. Let's do those first. Let's get an engineering feasibility study. And they would have found out what they needed to know long before they had already spent like $9 billion of taxpayer money to get into this situation now where the budget is 105 billion and probably more.
Yeah, that's crazy. Well, they're going to have to read your book and make sure they do that next time. I don't know if you've got, I know we've went just slightly over. I don't know if you've got.
I'm fine I've got a little bit.
Great. The last question I had for you, we can't talk about quitting in 2022 without talking about the Great Resignation. That is on every newspaper and news articles talking about it nowadays. So I'm just curious to get your take on that. Like, what do you think is going on here and what's your take on it?
So I think there's a great lesson from the Great Resignation. So remember I said the interesting thing with the Stewart Butterfield story is that Slack was always there. He just couldn't see it. Right. It's because he was focused on game never ending. So, and that's true of all of us, right? Like if you're in a job, obviously when we're talking about the Great Resignation, when you're doing a job, you don't necessarily see what the other opportunities are for you. You're just kind of like on a path. It's the status quo. It's kind of what you do every day. And you're not thinking about it as a starting decision every single day, right? You're not thinking about what the other opportunities are. So there's an interesting thing, which is sometimes people are forced to quit. So Stewart Butterfield was forced to quit his first company because he ran out of cash. That's forced quitting. If you're fired, you're forced to quit. I was actually forced to quit graduate school because I got sick. So I had to take a year leave. I didn't have a choice. So, forced quitting, obviously, i.e. being fired or for some reason being prevented from doing something you're pursuing. I'm not saying it always works out and always has a happy ending, but there is a side effect of it, which is it causes you to go explore other things. Because by definition, you have to, right? So, so in my case, there's no doubt if I hadn't gotten sick, I would have never played poker ever. because I would have just gone along. I was going out for all my job talks. I would have gotten a professorship and I just would have been Professor Annie Duke. So so now that brings us to the Great Resignation. I think that we think of the Great Resignation as just sort of across the board, people started quitting, but that's actually not true. There was a particular sector which was forced to quit when the pandemic hit. And it wasn't people like you and me who work from home, who just ended up on Zoom, and our meetings were on Zoom instead of in person. It was people in the service sector. So, hotel workers, restaurant workers, so on and so forth, who are now furloughed, laid off, or even fired, as businesses are going out of business or people are having to downsize and whatnot. So those particular people now are forced to quit, right? They cannot go to their jobs. And what you find is that when the great reopening happens, meaning, the world opens back up and now there's lots of jobs available, that the people in the service sector who were forced to quit are the ones who are actually the great resigners. In other words, when those jobs come back to them, they're quitting them, but not just quitting to do nothing. They're quitting to go take a different job. And I think that this is like such an incredibly important lesson, right? Is that the thing that we are very bad at that we don't do is explore. We don't explore other options. We don't think about what could I be doing with this time, or what other things could I be doing with my career? What other jobs could I be taking when we're already doing something, when we're already focused on something, when we're already on a particular path?
Yeah, it's really hard to have that mental space, right?
Exactly.
Yeah.
And what you saw with the Great Resignation is that all these people were forced to quit. They then were forced to explore not just what the other opportunities are, but what are my values? Do I actually like my job? Is there something I could be doing that would be more fun, that I would find more fulfilling? And then when the opportunity for them to go back to their jobs comes back to them, they quit to go do something else. And, what I feel is sort of like we need to take that lesson, which I think Stewart Butterfield embodies so well. The first time he was forced to quit, and that caused him to explore and go, and he sees flicker. The second time, he didn't wait till he was forced to quit. He did it on his own and then explored other things. And I think that's the lesson from that, is that it shouldn't take a pandemic for us to think about our values and whether we enjoy what we're doing, and to explore what the other opportunities out there for us might be. We should be doing that. You could do a quarterly review for yourself. Right. And I think that that's something that's just really important to take as a lesson.
Yeah, I love that. Yeah, that's a great take. I agree. Like the certain amount of people, even, you said about the service workers and stuff, definitely. They were forced to, but even people who were working on Zoom, like I know the amount of people I know who just said, what am I doing? I've just been kind of in this mode of doing the same thing because, like the famous saying of the three most addictive things are heroin, sugar, and a paycheck, or something like that.
Yeah.
And because you kind of just get in the flow of doing it every single week. And sometimes it is like a forced, like a shake up to say like, hey, is this really what you want to spend the next 20, 30 years doing? Or do you need to find an alternative? So
look, we see this in relationships all the time, right? Like people are in relationships that aren't great. And then they break up. It's painful. Right. I'm not saying like it's fun to get fired from your job. Like, obviously it's not. It's painful. But then what happens, not all the time, but a lot of the time, is that they look back on that and they say, wow, I really dodged a bullet because now I'm with this amazing person.
Completely.
100%. So, and again, I'm not telling people like break up with everyone or quit your job, because I just want to go back to, it's the distinction between, is this worthwhile? Does this align with my values? Is this getting me toward where I want to go versus isn't it? Right? Like, I'm in an incredibly happy marriage. I don't want to be forced to quit it. I don't want to quit it myself. But I have been in relationships where I knew that they weren't good, and I stayed in them much longer than I really ought to, for all the reasons that we do that, because we want to try and we want to turn it around and all of these things. And when it finally ends, whether it's me or them, it's just this huge like, and it's scary. And you wonder, am I going to find somebody else and all of those things? But you know what? Like, Sometimes you don't, but like a lot of times you do. And that's what I want people to sort of really get down to. It's like, you know, is this worth my time? Is it not? Because if it's not worth my time, I need to get to that quitting decision a lot earlier than I otherwise would have. Here's an example. I had an idea for a book after my last one. I actually did some work on it. I started doing some research. I was starting to outline it. And then I was thinking about the book Quit. And I realized as much work as I'd done on the other book, it wasn't exciting me as much. It wasn't as interesting a topic to me as this one was. And I just shoved it over to the side. I don't know if I'll ever go back to it, but I quit it. And I put quite a bit of time into it. And I started writing this book because I realized, no, that's not really in comparison. It's not as worth my time as this new one is. And, you know, and so that, I think that's a good example, right? It's like, figure out what's worthwhile and what's not. And funnily enough, I thought Quit was a book that was so worthwhile that I didn't want to quit it. So there you go.
Yeah, fair enough. Well, listen, thank you so much for taking so much time today. We went through a lot of the book and a lot of the concepts, but there's a lot more in there. So people should go check it out. It'll be out by the time this goes live in a few days. It's called Quit, The Power of Knowing When to Walk Away. And you should also check out your other books as well. I accidentally said your last book when there's actually other ones in between. So
there's only one in between.
Okay, so 3 total, yeah, okay.
And don't worry that so there's one in between. So I wrote Thinking in Bets, then I wrote How to Decide. But here's the deal. There was a printing error that occurred. So, you know, luck gets in the way. There was a printing error, and How to Decide ended up getting released in October of 2020 during the American election. So I'm not sure how many people actually know this book exists. I like it. You know, I mean, it's not a big idea book in the same way that Thinking in Bets is. So I was never expecting it to do as well as Thinking in Bets. But I do think there was also a little bit of bad luck in there, because I talked to all sorts of people who are big fans of Thinking in Bets, who you would assume would know that this other book exists, and they don't. It was really hard to break through that noise. Yeah, so I don't know. Maybe people will discover it now because people are paying attention to this new book. We'll see. But
completely. But yeah, I really enjoyed all the ideas. I'm glad we got to talk about that monkeys and pedestals thing. That was probably my favorite part.
Oh, good,
I had it on my list to ask you, but I thought we were hitting time. So I'm glad we got to talk about that. And yeah, thanks again for coming on the show. Love to do this again in the future. I'm sure you've got a lot more of these in you. And I appreciate you taking time.
All right. Well, thank you so much. This was super fun.
Cheers. Thanks. Have a good one. And yeah, let us know what you think of this on Twitter. And we will see you on the next episode. Cheers.